Welcome to the FinanceOffer podcast. In this episode, we are diving into the hidden mechanics of monthly maintenance fees and exactly how banks generate revenue from it. To understand how these systems really work behind the scenes, let's start with a scenario that happens to thousands of people every single day. Let's introduce you to Alex. Alex has a standard checking account. He's a responsible guy and usually keeps a decent buffer of cash in there, but life happens. His car needs a new alternator, his dog decides to eat a sock, resulting in an unexpected vet bill, and suddenly his account balance drops to $200. Now, in his mind, he's totally fine. He isn't overdrawn. He isn't borrowing money from the bank. He isn't using a credit card. He's just keeping his own money in his own account. Then, the calendar flips to a new month. A mysterious $15 charge appears on his statement. The label just reads monthly maintenance fee. Alex hasn't used any extra services. He hasn't spoken to a teller, requested a cashier's check, or asked the bank to do any heavy lifting. He just existed. And for the privilege of letting the bank hold his $200, he was charged $15. Now his balance is $185. The core problem here is the invisible penalty for falling below an arbitrary line. The bank is generating steady, predictable revenue simply by hosting an account that doesn't hold enough cash to make them massive profits elsewhere. By the end of this episode, you'll understand exactly how this threshold trap is designed, why the bank relies on it so heavily, and the exact mechanics that turn your temporarily low balance into a recurring revenue stream for financial institutions. You'll see the matrix of the maintenance fee, and you'll never let it catch you off guard again. So why does this topic matter right now? It matters because the era of the genuinely free, no-strings-attached checking account is quietly disappearing from traditional brick-and-mortar banking. If you walk into a major national bank today, you aren't just a customer, you're a math equation. And if your equation doesn't equal a certain profit margin for them, they will balance their books by charging you directly out of your own pocket. This affects absolutely everyone who uses a traditional bank, but it disproportionately impacts people who are trying to build their savings from scratch, college students, freelancers with irregular income, and anyone recovering from a sudden financial emergency. The cost of misunderstanding this system is steep. It isn't just $15 or $20 a month. It's the compounding erosion of your capital. It's a leak in your financial boat that happens below the waterline. If you don't understand how this fee is triggered, you will end up paying $180 a year just to access your own money. That is a subscription service nobody asked for and nobody wants. There's a structural reason why so much confusion exists around this topic. Banks don't advertise these fees on the front door. They advertise the shiny perks. They sell you on the free coffee in the lobby and the sleek mobile app. The maintenance fee is buried deep in a PDF of account disclosures written by corporate lawyers for corporate lawyers. It's framed as a standard operating procedure, a tiny little hurdle that you can easily jump over by setting up direct deposit or keeping a high daily balance. But the reality is much more calculated. Let's break down exactly how this mechanism operates, step by step. First, let's look at the predetermined financial threshold. This is the tripwire. When you open your account, the bank establishes a minimum daily balance. Let's say it's $1,500. If your balance dips to $1,499 for a single day, the tripwire is crossed. The bank's automated system flags your account. Here's what is happening behind the scenes. The bank has recategorized you. You've instantly moved from being a profitable asset to a liability in their algorithm. Why does this happen? Because banks make their primary money by taking your deposits and lending them out to other people at a higher interest rate. If you only have a few $100s in your account, the bank simply can't lend enough of it out to make a meaningful profit. So they need to monetize you another way. The threshold is simply the exact line where they stop making money off your money and start making money off your fee. A very practical example of this is the modern gig worker. Let's say you drive for a rideshare app or do freelance graphic design. Your income naturally fluctuates. One month you have a massive project and you're well above the threshold. The next month, work dries up, you pay your rent, and you dip below the line. The bank doesn't care about your business cycle. You're penalized strictly for having variable income. The common misunderstanding here is that the bank is charging you for a physical service. They call it a maintenance fee, which implies that someone in a suit is going down into the vault with a wrench and a rag, manually polishing your specific digital dollars. But it costs the bank a fraction of a penny to host your digital account on their servers. The fee isn't covering overhead, it's purely generating profit. Next, let's talk about the automated deduction. Once that tripwire is crossed, the institution levies the recurring monthly charge. It's automatic, cold, and entirely devoid of human empathy. On the statement date, the money is simply subtracted from your total. What's happening here is a forced extraction. It's essentially a negative interest rate applied to your own cash. Why does it happen this way? Because friction is the bank's best friend. By automatically deducting the fee, the bank relies heavily on your inertia. They know you're busy. They know you probably won't notice a $15 drop in a sea of grocery store transactions, gas station runs, and utility bills. And even if you do notice, they know the hassle of calling customer service, waiting on hold for 40 minutes, and arguing with a representative is usually enough to make you just accept the loss and move on. Here's a real-world example. You check your bank app on a Tuesday and you have exactly enough money to pay your electric bill that's scheduled for Wednesday. But overnight, the monthly maintenance fee hits. Suddenly, your electric bill bounces. Or worse, the bank pays the bill, but hits you with an overdraft fee on top of the maintenance fee. It's a financial domino effect triggered entirely by an automated system. The common misunderstanding is that this fee is a gentle nudge to remind you to deposit more money. It's not a nudge, it's a toll booth on a road you already paid for. Here's where it changes from a simple fee to a structural trap. We call this the erosion cycle. Every time the bank takes that monthly charge, it continually erodes your funds. It actively makes your balance smaller. What is happening is a simple, cruel mathematical reality. If your goal is to get back above that $1,500 minimum to avoid the fee next month, the bank has just made that goal mathematically harder to reach by taking your money. You are trying to climb out of a hole, and the bank is standing at the very top, kicking dirt back down on your head. Why does this happen? Because the system isn't designed to help you recover your financial footing. It's designed to extract maximum value while you are vulnerable. Imagine you're trying to save up an emergency fund. You scrape together $500 hard-earned dollars. But because you are under the minimum threshold, the bank takes $15 every single month. In just 1 year, they have taken $180 of your savings. Your emergency fund is bleeding out simply because it isn't big enough yet. The common misunderstanding is that small fees don't really matter. We are conditioned by modern society to ignore microtransactions. But this isn't a microtransaction. This is a sustained leak in your financial foundation. It makes it increasingly difficult to reach the fee waiver minimum because your starting point keeps moving backward every 30 days. Finally, let's look at the waiver illusion. Banks love to loudly advertise that checking is free if you meet certain criteria. Just set up a qualifying direct deposit. Just use your debit card 15 times a month. Just keep a massive minimum balance across multiple linked accounts. What's happening here is pure behavioral engineering. The bank is forcing you to make them your primary financial hub. Why? Because if your paycheck goes there and all your auto pay bills are tied to that account, you are statistically incredibly unlikely to ever leave. You become what the industry calls a sticky customer. The waivers aren't a favor to you. They are a ransom demand. Meet our behavioral requirements or pay the penalty. A practical example is the college student who gets a summer job. They set up direct deposit and the fees disappear. But then August rolls around, they go back to school full-time, they quit the job, the direct deposits stop, and boom. The fees start rolling in exactly when they have zero income and can least afford it. The misunderstanding is that these fee waivers are generous offerings. They aren't. They are calculated hurdles designed to trip up a specific percentage of the customer base. Let's step back and look at the deeper principle at play here. Why does the banking system actually work this way? It comes down to incentive alignment and a concept often called the penalty for being poor. Banks are fundamentally data and logistics companies that trade in risk and capital. When interest rates fluctuate or when banks face strict government regulations on how much they can charge for overdrafts or credit card late fees, they have to find revenue somewhere else to satisfy their shareholders. Enter the maintenance fee. The system works this way because it is an incredibly reliable, low-risk revenue stream. The bank doesn't have to issue a risky loan or take on any market volatility to collect a maintenance fee. They just have to run a simple line of code on a server. The incentive alignment here is fascinating and honestly a little bit grim. The bank is financially incentivized for you to have just enough money to not close the account entirely, but not quite enough money to trigger the fee waiver. That narrow window is the absolute sweet spot for their fee revenue. This reflects a much broader financial pattern across our entire economy. It is incredibly expensive to not have a lot of money. If you can afford to lock up $10,000 in a checking account that pays 0% interest, the bank will treat you beautifully. You get free checking, free cashier's checks, and premium customer service. Your wealth subsidizes your experience. But if you are living paycheck to paycheck or simply trying to rebuild your finances after a setback, the system treats you as a profit center to be mined. You are paying a premium simply for participating in the digital economy. The overarching lesson here is that traditional financial institutions are not public utilities. They are profit-seeking enterprises, and if you don't understand their rules, you will become the product. Let's quickly recap what we've covered today. You now understand that a monthly maintenance fee isn't a charge for a service rendered. It's an arbitrary penalty levied when your account balance falls below a predetermined threshold, changing you from an asset to a liability in the bank's algorithm. You understand the erosion cycle where this recurring charge continually eats away at your funds, acting like a negative interest rate and making it mathematically harder to climb back over the minimum balance required to stop the bleeding. And you understand the behavioral engineering behind fee waivers, which are designed to force you into making the bank your primary financial hub through direct deposits and linked accounts. Armed with this structural clarity, you can now look at your own bank statements with a totally different perspective. You can identify these threshold traps before you fall into them. If your current bank relies on this extraction model, you now have the knowledge and the confidence to move your money to an institution, like a local credit union or a modern online bank, that aligns with your financial growth rather than taxing your temporary setbacks. You're in control of where your money sits. If you found this breakdown helpful and want to continue learning how the financial system really works, please hit that subscribe button, give this video a like, and leave a comment below with a financial topic you want us to cover next. Thanks for watching the Finance Offer podcast, and we'll see you in the next episode.